Hey guys, hope everybody's doing well today. Got a special edition, special Wednesday edition. I haven't been doing these very often. Been kind of busy in real life, and it's been a challenge to try to get 2 videos out a week. But this one was actually spurred on by a comment from one of the viewers down in the comment box down below. Obviously I read all those comments, so it takes some time for me to respond to them all, because sometimes YouTube actually delays notification and sometimes doesn't notify me of comments at all. So sometimes I just go through there and check them out. But today I'm going to look over an ETF that a viewer suggested that I look at, and we'll go over that today and see whether it's a liked one by GW or not. Okay. But I want to welcome you to the channel. If you're new here, please like, share, subscribe, do all that good stuff. Leave me a comment down below. Let me know you're new here. I'd love to chat it up with you. Also down in a pinned comment below, if you'd like to support the channel, there's some great affiliate links in there. The good one right now is M1 Finance. If you don't have an M1 Finance account, M1 Finance, when you deposit $100 into a new account, they will give you $30, and they'll give me $30 just by using that link down in the pinned comment. So that's a win-win. There's an Amazon link down there. If you do any kind of shopping on Amazon, if you go through my link and then just shop what you normally shop for, Amazon will send me a very small commission on qualified purchases. So another great way to support the channel, and I'd appreciate that. So we'll get on with it. What are we looking at today? We are looking at an ETF called HNDL, and its ticker symbol, well, it's not up here. It's actually not up here. Its ticker symbol is HNDL, and we'll go to it, and I'm going to read you the description here, and it's a target distribution ETF. Now, the Nasdaq 7HANDL Index ETF is a first of its kind target distribution ETF designed to seek investment results that correlate generally before fees and expenses to the price and yield performance of the Nasdaq 7HANDL Index. Now, what is the 7HANDL Index? That's a good question, because I was like, what the heck is it? Basically, it seeks to represent an allocation to a balanced portfolio of low-cost ETFs that it provide exposure to U.S. equities, bonds. Apparently, I don't like bonds, and alternative investments, and employs leverage in an amount equal to 23% of the total portfolio. To achieve this leverage, the Nasdaq 7HANDL ETF holds a total return swap on an unleveraged version of the index, the Nasdaq 7HANDL Base Index. Are you confused as much as I am? I am, because I even read this quite a few times, and I went and looked at some stuff. We'll look at what the total return swap is, and I'll let you kind of devour and see if you know what that actually means. But the Nasdaq 7HANDL ETF has adopted a policy to pay monthly distribution on fund shares at a target rate that represents an annualized payout of approximately 7% on the fund's per share net asset value on the date of a distributions declaration. So they pay monthly, they pay about a 7% annualized yield, and they've been pretty steady. We'll go through that, and we'll look at the history and all that. All or a portion of the distribution may consist of a return of capital from the original investment, and the distribution rate may be modified at any time. Now, if you don't understand return of capital, it is essentially returning your own money to you. But if the fund can maintain the net asset value and grow its net asset value while returning your money to you, that is actually quite okay, because you cannot be taxed on a return of capital. So if it's classified as return of capital distribution to you, you pay 0 taxes on it. And if the fund is able to maintain growth and increase the net asset value, that's a win-win. So let's go back to this. What is a total return swap? I'm going to do just the very little brief introduction of it, and you'll probably be just as confused as I am. So, what is a total return swap? This is off of Investopedia. I'll leave their link down there so you guys can read it. A total return swap is a swap agreement in which one party makes payments based on a set rate, either fixed or variable, while the other party makes payments based on the return of an underlying asset, which includes both the income it generates and any capital gains. In total return swaps, the underlying asset, referred to as the reference asset, is usually an equity index, a basket of loans, or bonds. The asset is owned by the party receiving the set rate payment. It goes down here to understanding and all that, but it's advanced trading that hedge funds use a lot of times. So if you want to learn more on that, I'll leave that down there in the link down below. So we'll go over here to Fidelity, where I like to do a lot of my ETF examinations, if you will. And we are in handle, HNDL. No rating from FactSet and no rating from Morningstar. This is a small ETF, has about $180 million in net assets. It has a huge expense ratio of 1.17%. Pretty expensive for an ETF, especially considering that it is just a fund of funds. Besides that total return swap, I don't know if there's expenses towards that, but 1.1% just to put together a bunch of ETFs and manage a total return swap, whatever is involved in that, seems a little high. So we'll go down here and look at the portfolio composition, and we will see, we're going to go and look at all the holdings here, but basically it has 21 holdings, mostly all North America, 98%, 97.5%, and 1.5% in Asia, a little bit in Europe and Latin America and the Middle East. 94% in the United States, and just under 1% in all these other countries. So what we'll do is we'll look at all holdings by weight, and we'll see that we have the first holding is dollars on deposit number 15, which has 10.76%. I don't know what that is. I'm assuming that it is that swap thingy majig. Your second holding with a 10.26% weighting is a Sector Spider Portfolio Aggregate Bond ETF. Your third is 10% in a U.S. Aggregate Bond ETF. Fourth is 10% in a Vanguard Total Bond Market ETF. 7% in a Hartford Total Return Bond ETF, 7% in iShares Mortgage-Backed Securities ETF. Then we get into some equities finally. 7% in QILD. If you don't know what QILD is, I'll leave some videos down below. 7% in QQQ. That's nice. Got you some growth at least. And then we're back to the bonds again. We got 6% in high yield corporate bonds, another 5% in intermediate term corporate bonds, 4.5% in preferred shares, which is kind of a bond hybrid, 3% in a taxable municipal bond, which are your cities and local municipalities. That's how they raise money for like roads and services and things like that. 2.3% in VTI, which is the total stock market. So that's a good quality holding. I don't understand this one. Got 2.2% in ITOT, which is very similar, very, very similar to VTI. So that doesn't make sense to me. And then you got 2.2% in VOO. Okay, now this is getting funny to me. VOO, ITOT, VTI have extreme overlap in it. 1.4% in FUTI, which is, I like that name, FUTI. It's a Fidelity Sector Utilities ETF. 1% in VIG, which is Vanguard Dividend Appreciation. 1% in NTSX, which is a Wisdom Tree 90/60 US balanced. I don't know what that is, but it sounds like a fund of funds inside this fund of funds. MLPA 0.46 in the Global X MLP ETF, which are energy companies. And then Nasdaq 7HANDL, I don't know what that is, but it's very little in there. And then less than a quarter in the Schwab US REIT ETF. So, what are my thoughts? I don't know. I mean, if you're going to pay over 1% for this, I'd like to have some rhyme or reason to what they're doing. At first I wasn't too, I don't like bonds in the beginning, but here you got two aggregate bond ETFs, total bond market ETF, and then a total return bond ETF. It seems very, very thrown together, and I don't understand. I really don't understand. You got VTI and ITOT, which are very similar. Then you got VOO, which is in both of those. So I'm not a fan of this. If you're going to be an active managed ETF, active manage it, right? Don't just throw a bunch of stuff together to meet the requirements of the prospectus of the ETF. That's my thing. So, we'll go to my ETF channel, and I'm going to compare this because the people that are going to want this kind of portfolio are looking for yield. They're looking for a 7, that's the attraction to this. It pays a monthly monthly distribution with a 7% yield. And I think bonds are, for the most part, horrible investments at this point. They're dead money. Bonds are dead money. And I probably shouldn't say dead very much because I'm probably going to get flagged on YouTube. But bonds are just, they're nothing. I mean, you can get some corporate bonds that pay some decent yield, but the higher the yield that those corporate bonds pay, there must be something wrong with those companies that are got to pay that much to loan out or to get loans from bondholders. So let's take a look at it. I think it really if you want a 7% yield, you want downside protection, you want to preserve your capital and get a monthly distribution, I think NUSI is a good fit for you. It doesn't have any bonds. It's a Nasdaq 100 fund, but it employs a protective option strategy within it. It doesn't have leverage. It's about half the expense ratio of HNDL, and it outperforms it in a big way. So let's check it out. We'll look at NUSI. You already got it put in here, and we'll chart 10,000 invested in handle. And we'll look from December 20th, 2019 through yesterday, January 25th. Your total return for HNDL isn't bad, actually. 13.1% with an average annual total return of 11.83%. Now, that's only a year and a month, basically. But NUSI has given you almost 21% in that same time period, and an average annual total return of almost 18.83%. And what I want to show you there is the downside protection that NUSI has. NUSI's here in the blue. So you see handle, this was probably March, or this last March, and handle really dropped. It looks like it dropped 30%, and NUSI I think it dropped about 13 or 15, maybe 10%. I forget. Don't quote me on that. But that options collar strategy that they use really protects the downside. and then it gives them some opportunity to capture the upside. Now it had, NUSI is actively managed as well, so they can put on and take on and off their option strategy as they see fit. So sometimes that might not work as well, and it dropped a little further here, but it caught up and just kept running. So NUSI would be my pick if you needed a 7% yield, if you needed monthly payments, and you wanted downside protection and all of that. So NUSI's my pick out of this one. Handle, you're too expensive for me. Some of your holdings are just redundant, and it doesn't seem like you are actively managing your fund. So those are my thoughts. Give me your thoughts. Put them down below. Like, share, subscribe, do all that good stuff, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.